We investors have a beautiful talent. We buy a stock after 3 reels, one confident WhatsApp message, and a chart with 7 arrows, then call it long-term investing because the price fell and now we have no choice. Benjamin Graham begins The Intelligent Investor by attacking exactly that confusion. Before he teaches valuation, portfolio policy, or margin of safety, he asks one uncomfortable question: are you investing, or are you speculating? This is an educational book summary episode from The Intelligent Investor by Benjamin Graham. Today we are using Graham's first filter to separate real investing from speculation in disguise. That question sounds simple. It is not. Most investing mistakes begin when a person performs a speculative act but gives it an investor's label. Graham's classic definition is strict: an investment operation is one that, after thorough analysis, promises safety of principal and an adequate return. Anything that does not meet those conditions is speculative. Notice what this definition does. It does not say speculation is evil. Graham is practical. He knows speculation exists, and he knows some people will do it. But he wants it named honestly, sized modestly, and kept separate from the real investment program. If you speculate, do it with your eyes open. Do not mix it with your serious money, and do not upgrade it into an investment because the word sounds more respectable. The core framework for this episode is the 3-part Graham filter. First, analysis. Have you actually examined the business, security, fund, or instrument? Not a vibe. Not a quote from someone who uses too many rocket emojis. Real analysis means asking what you own, how it earns, what can go wrong, and what price would make sense. Second, safety of principal. Graham does not mean the price can never fall. He means the decision must have protection against permanent impairment. That protection may come from diversification, asset strength, earnings power, a conservative price, or a structure that does not depend on heroic assumptions. Third, adequate return. The expected reward must be reasonable for the risk taken. If the only attractive part of the decision is a fantasy outcome, Graham would not call that investment. He would call it what it is. Here is the practical case study, a hot new issue in a bull market. The story is exciting, the price has already run, and everyone says the future is huge. The investor who buys only because the quote is moving is not analyzing value. He is relying on someone else arriving later at an even higher price. That can work for a while, but Graham wants the label to be honest, that is speculation. Now compare it with a slower decision. An investor studies a diversified basket, checks valuation, knows the role it plays in the portfolio, and accepts that the price may move against him for years. That is not automatically a good investment, but it is at least operating in Graham's world: analysis, protection, and adequate return. The checklist item is simple. Before you put money into anything, write one word at the top of your note: investment or speculation. If it is speculation, write the maximum amount you can lose without damaging your life, your plan, or your sleep. If you cannot write that number calmly, you are not managing risk, you are negotiating with excitement. In the next episode, we move to Graham's defensive investor, the person who wants a good life and a sensible portfolio without turning every evening into an unpaid analyst internship. Thanks for listening. If this episode helped you label a decision honestly before risking money, that is the real goal. Until then, drink some water, stretch your neck, and remember, you do not have to answer every notification like it is a court summons. Some messages can wait. Your spine will appreciate the revolution.